President Biden signed the debt limit bill into law Saturday, averting what could have been a financial disaster, not only here in the U.S., but all around the world. The bipartisan legislation suspends the debt limit through 2025 and beat the deadline with just 2 days to spare. Joining us now for some insight on the debt limit and this week's jobs numbers, we welcome in financial expert and good friend, Morgan Stanley's George Noceti on a Sunday. Good morning.
Thank you, Frank. Good to be here.
Good to have you. Well, let's talk about that debt limit bill down to the wire, but for the first time in a while, it appears the two parties actually brokered a bipartisan deal.
Yeah,
a
that's
very
exactly
big deal.
Exactly right. I think Mick Jagger says it's best. You can't always get what you want,
but if you try,
sometimes you might find you get what you need.
Right on.
That's exactly what happened. Joe Biden got what he needed, but not all that he wanted. And the most amazing part is that Speaker McCarthy, who was elected by a thread, who can be recalled at any time, didn't have 100% of the Republicans behind him. So he really had to negotiate a new term, negotiate with the Democrats. And the end result was that he got probably some of what he needed and maybe not all that he wanted, and everybody's not happy, but it was amazing. We had a real negotiation. And that's, Frank, that's just so good for the global economy, for our national economy, for consumer confidence and the stock market when we approach things from a negotiation. Once we negotiate, then we can go forward and make things happen.
Yeah, you could move. No gridlock, a bit of a compromise, but all good.
Right.
Well, the market, as you know, soared on Friday some 700 plus points.
Yeah.
How do you think the market will react tomorrow, or do you think this was already baked in, assuming the president would sign on the dotted line?
Well, the cliff was already baked in that we wouldn't hit that. I mean, nobody under nobody's watch wants to be responsible for a physical cliff. It's Armageddon if that happens. So McCarthy, Biden, they just don't want that. They will disappear. They would have disappeared really if we would have fallen off the cliff. So that didn't happen. But what's really propelling the market right now is really the euphoria around tech. I mean, NASDAQ is up about 22%. That's really fueled by this artificial intelligence that's been around forever, but we're just talking about it now. There's really about 5 or 6 companies that have market caps of $1 trillion to $2 trillion. They're really moving the market right now. So investors have to be careful. They could be getting a false positive. The S&P 500 should really be up about 1.5–2% really year to date. But the euphoria of tech is really, pushing it forward. So we're getting, again, a high price, low earnings. We expect to pull back maybe between now and summertime. We'll get back to normalization. So investors need to be a little more defensive. You get paid for sitting on the sidelines holding cash right now.
All right. Well, let's talk about the jobs numbers. They, too, came out this week for May. 339,000 new jobs, much higher than the 190,000 that were expected. That is, I believe, 29 straight months of job growth. But unemployment actually went up. How does that work?
Frank, it's a complicated phenomena that really nobody can explain except to say that this U.S. economy is the envy of the world in job creation. I mean, we only need 150,000 jobs a month to break even. We doubled that. Even in spite of raising these interest rates, we continue to do this. Now, the unemployment rate has been incredibly low. It ticked up a couple of tenths of a point. That could be a tracking error. That could be, individual contributors, sole practitioners. It's summertime. They stop working. Then they come back in. Getting a job is not that difficult. Usually about 7 to 8 weeks between jobs. The number of jobs available increased from about 9 million to 10 million. The Federal Reserve works against what they're doing in terms of raising the interest rates, because when people work, they spend money, and it's a lot of money chasing fewer goods. That raises price.
You brought it up earlier, but interesting note, AI, artificial intelligence, the chip stocks are going nuts right now. AI actually took away some 4,000 jobs from people in the month of May. Is that something to keep an eye on or be concerned about?
Oh, no, we should keep an eye on it. I mean, but just to keep this in perspective, Frank, in 1979, the first graphics card enabling AI started. And if you look at Moore's Law, which really says the microchip processor will double in capacity every 18 to 24 months. So it starts off de minimis, incremental, but the doubling gets bigger and bigger. Well, now we're at the point these last 30 years where AI is actually integrated really in all functions of our business. We may not know that yet. It's just become pop culture lately, but artificial intelligence is there. It's an efficiency gainer, and it can be a job killer in the beginning, and then it could be a job generator, towards the end. Like all technologies, they increase productivity by reducing labor, and then they create other kinds of jobs. The real challenge for consumers is you got to be willing to change with the environment. And so for the baby boomers, it's a lot more difficult to change.
Right.
For the younger people, they can change their skill sets, but it's going to be challenging. But AI is here, not at the mission critical level yet, but it's in all functionality. We may not see it, but it's here.
It's coming, that's for sure. All right, George, we got to leave it there, but thanks for getting up on a Sunday and having a chat with us. We always appreciate it.
Okay, Frank, always good talking to you. Thank you.
All right, George Noceti with Morgan Stanley.